Hey there, traders. We're back for two recaps, one for Thursday and one for Friday. Today is Sunday, or at least when I'm making this, it's Sunday evening. The futures are going to get underway, start trading pretty soon. It's almost 6 o'clock p.m. Eastern. So we're going to talk about what happened Thursday and what happened Friday. So the last time we talked was Wednesday. They closed above the zone. And then at 4 o'clock, there was that whole tariff speech by President Trump. And we talked about what happened in the aftermarket. Little trade I got up there, pulled a few points. So it shouldn't be too surprising that they've dropped from there. Went back and checked. I think the first time we started talking about this zone down here was toward the beginning of March, like maybe call it the 5th or 6th or 7th or so. It was before they got down here. So if you're interested, you can go back and look at the recap videos talking about what they need to do with this zone. This was an area they could bounce. Let's look at a weekly chart just to zoom out a little bit. So they're coming down into this zone. The bulls had every reason to bounce from this area. But when they started closing candles below, by the time they got back below it the second time, things weren't looking like a bounce. The bounce would have been right from here. So we've been talking about them getting below the zone means they're going to go lower. Something else is happening. That's like maybe the 20% of the 80-20 rule. So there are targets on the downside. It's a little early to look at a monthly chart because we're only on the 6th of April so far, but look what they've done so far with the monthly. So we've been talking about how 610 was a target. Show you how that is derived, or where that comes from. Is you've seen this before. It's a Fibonacci extension from this low way back here in March of 2020, the highest they made, lowest they made back in October of 2022. And 610 was a 100% retracement or a symmetrical move from here to here applied to this low. You'll see this kind of thing happen fairly often. It's a target that the market will at least stall out for a while. Not only did they stall up here, they gave some signals that they were going to come down. And we've known this for a couple months already. But we can run another indicator and make some observations on this monthly chart. If you take this low, run all the way up to the highest that they got back in February, you can see they're coming down into some retracement areas. They're always going to hit retracements on the way down. And there were reactions around this 38% retracement. Now they're coming down into the 50% retracement. You have a 50-period moving average coming up, which is right in between it and the 618 retracement. And coinciding with this 50% retracement is an area that the market got to previously and was rejected, got way below, came back up, and fought above it. Generally speaking, not always, but generally speaking, if price comes down into that same area again, it's going to be pretty good support. So that creates a very large zone right here of possible support where the bulls might come in and defend this bearish party going on. So with all that back in mind, we're looking at a daily chart. And this is a possible target well below current price, but at the rate they're falling, anything can happen. Since it's after 6 p.m. on a Sunday, I figured I would come over to the futures just to see what they're doing. And look at this, a gap down, this 6 p.m. open, 100 points or so, and they're just falling. Can't say that's too surprising at this point. I'll give you a minute to run through the daily levels and the game plan for Thursday. That's April 3rd, sent out before the opening bell. You can read through that. It should go without saying. But when you expect increased volatility, you should be more careful. So that's what I've touched on here. Talked about giving the levels and price action around those levels more time to work, more room to work. Just a few other best practices. So this was Thursday, and Thursday it looked like this. There's a big gap down on Thursday. No need to put a vertical line to delineate the start and the close of the day. So they came down into 545.32, easy base hit. If you were playing by the rules, you're going to ignore the level the next time they come back around, which they did. They just felt after that bounce, they fell back through it. There's a rule for that. They came down into 540.48, and that's another good bounce. It would not take very much at all to pull 4 points out of any of these levels. I did take one trade on Thursday, and I'll show it to you. Now they're on the underside of 545.32. That's an opportunity to take another trade on the short side. However, with what price did when they got up to 545.27, that's as adjusted, that's the price, that's the level pulled down toward price, 5 cents. It gave you a near miss. They came up within a penny or so, 1 or 2 cents, 2 different times, and pulled away both times for enough for a base hit. That's a clue, according to one of the rules, that there's a chance that that was the trade. If they get above, they could stay above and continue to go higher, at which point you do not want to be in a short position. That is a near miss, and we're not going to take a trade on the short side at 545.27. Obviously, it did work after being out of the money a little bit, but we won't count this. We're going to say it's a near miss. But I do want to reiterate that giving these levels more wiggle room is what this is all about. They're back down to 540.48, and while they did bounce, got above. We already took a long trade over here, so we're not going to trade it the second time. They got down into this zone. By the time they got to the top of the zone, hit these levels, it was after our cutoff. We don't want to trade anything after 3:30 p.m. Eastern. This whole area worked as support, but according to the rules, it's off limits. But that was a couple of base hits worth 8 ES points if you were playing by the rules. And we'll take a look at the trade that I took. Notice the date, the time. Market opens at 9:30 a.m. Eastern. And this first level, this first trade, I just was busy. I forget what happened actually. Didn't take the trade, so when I came back and saw what was going on, I marked that level, dashed. And I'll scrub ahead here to the next trade, which is down at 540.50. I just kind of rounded it, the level to 540.50, just a few pennies away from where it was. That was kind of my 5-cent buffer. And went long there with 2 contracts and held out for 8 points. With the kind of moves they were making, I figured that would be pretty easy. And it was. I'll just move ahead here in the interest of time, show you that trade in the bag, and that's all I did for the rest of the day. I'll let this go till, what was it, 2, 3? Yeah, around 3 o'clock or so. That was it for Thursday. Friday looked like this in terms of the levels, the game plan. Once again, I'm pointing out that it's going to be volatile, and you want to give price more wiggle room. Right here. If there was ever a time to give price action more wiggle room, now is that time. I didn't make any trades on Friday, and I said so right here. And this was sent out before the opening bell. And here are the 3 levels that the SPY hit on Friday. Talk through these really fast, playing by the rules. So the first trade was taken at 5:21.26. The reason is because after 15 minutes of settling in, the market was down here. Price was down here. They went up. So if you had went short at this level, and there were no rules violated to go short again at the next level, that was actually what you would do. Yes, you'd be a ton of points out of the money, especially with 2 contracts at this point. But you have to expect that kind of thing with a volatile market. The safe thing to do on Friday was just sit it out like I did, just not do anything. I mean, I missed some trades, and we'll get to that in a minute, but the point being, I had no stress. I recorded it, and by the way, if I can maybe play it down here and have that thing going while we're talking, because there was no trade second, nothing really to look at, just to show that I didn't trade anything. But the point is, these levels need more room to work. We're trying to be as precise as we can in a quote-unquote normal market. But when the market is not normal, when they've broken support and they're falling, like we've seen in the big picture, recessions and bear markets don't happen from highs. They happen when they break support and fall when they were supposed to have bounced and gone higher. Getting off topic a little, back to Friday, this is 2 short trades. You're going short at 521.26. or as adjusted, 5 cents below that. If you saw these top 2 levels kind of shift or move a little bit, because I just realized that I already had the 5-cent buffer applied when I was doing my analysis of what happened. So I moved them back to the original levels for the day, and that's what you see here. But in any case, you would have gone short at 521.31, gone short again at 523.98, pulled a base hit, and then some as they continued to fall. You would have ignored this level when they hit it again. And if you have taken the course or are taking it, you would know why. Although I have explained that before. And they're down to 512.34. That whole area was designed to be support, and they bounced as expected. Yes, they got out of the money, but once again, more wiggle room is required. Now, we're not going to take 521.31 on a short trade. So price continues down. Not going to touch this level on the long side because we've taken the trade, and they got under it here, 1:07 p.m. They got back up to it, 1:36 p.m. So typically, when price gets under a level and you haven't traded it on the short side, you could trade it on the short side the next time it hits it under certain parameters. And in a normal market, when price is behaving more or less normally, going short here wouldn't put you out of the money too much typically, unless there was some other reason that this whole area was good support and you're expecting price to go higher. In this case, the trend was clearly down, so going short is not a problem. However, because of all the volatility and big moves and ranges, if you were playing by the rules, you would have had a pretty big fumble. And this kind of falls under the same category as giving price more wiggle room when they did not react and pull down and give you a base hit, which is like really close. I mean, 4 points is hardly anything compared to the ranges, but they would have gotten out of money around 21 points. And while you could jump out and call that a loss, if you reversed and just withstood it, they went up another 10 points after that. That would have been a difficult trade, of course. Part of the reason I didn't want to trade anything on Friday. So as much as I'd rather say you should not have been trading on Friday, we're going to treat it as a process. Say you went short here like you normally would, withstood all that, had a pretty big fumble, reversed it, got a base hit on the reversal, and into the day in the red because of that. And this is what Thursday and Friday look like on the tracking log. We're at the PBR output, playing by the rules. Read through the notes and see that 2 base hits were possible. And then on Friday would have been pretty good. You would have been doing okay, 12 points up, but then taking that last trade would have given you a pretty big fumble not really going to call it max loss limit because of that wiggle room thing we're talking about. Plus, being on the short side was the overall plan for the day. So anyway, hopefully I explained that, but that's gave you another base hit on the reversal, but end of the day in the red because of that. And over on the Sam's trades output, I did manage to pull 8 points on Thursday, did not trade on Friday. So that's a wrap for last week. Also yesterday, Saturday, April 5th, I opened up the course, the E-mini Trading 101 course that's on the website. Well, it's available now. And by the way, before you go check out the website to look at it, check your email first. If you are among those who receive the daily emails each morning, I sent you a note on Saturday that you probably want to look at first. But the levels will continue to go out for a period of time before they become subscriber accessed only. We'll do some careful analysis tomorrow morning and look at what they did in the overnight session, compare that with the last week, just get a big picture, and we'll have some levels on the board. Things could look kind of crazy for a lot of people, so it could be a good time to sit back, but I'll have an assessment tomorrow morning and send that out per usual. Thanks for checking out the course on the website if you are interested, and I will talk to you again soon, tomorrow evening if all goes well, in the next recap video. Thanks, and have a great day.